Hello, everyone. My guest today is John Oechsle. He joined the small business CRM software provider SwiftPage back in July of 2012 and currently serves as the CEO. He came to SwiftPage with a 30-year track record of building highly profitable and sustainable revenue growth for emerging companies and established global leaders. John is an advocate for entrepreneurship and small business growth. John, are you ready to take us to the top?
I'm ready, man.
All right. Why do you like small business so much? Constant Contact did not have such a good outcome.
Oh, no. You know what? Small business is really a cool place to be. They need so much help right now, the small business. When I look at a small business, I say, you know what? They need four things in order to grow. We call them presence, traffic, conversion, retention, and optimization tools. And as SwiftPage, we are playing in conversion and retention as this little tiny email marketing company, quite frankly. And we said, you know what? Let's go out and be the 800-pound gorilla and just own conversion and retention and help these small businesses grow.
Go ahead.
Go ahead. No, I was going to say, I mean, you know why people don't like small businesses? Because it's really, really hard to get a critical mass of customers in small businesses. And it's really hard to do it in a profitable sense. So we could talk lots about that.
Well, and generally speaking, 9 out of 10 businesses fail. So your churn is naturally it's a hard thing to drive down. How have you kept your churn low and what is it today?
Yeah, so right now our churn is about 1.5%, a little under 1.5% on a monthly basis. So from
that's logo business, churn, right?
That's logo churn. Yeah, absolutely. And revenue churn is about that, maybe even a little lower from that standpoint. But anyway, how you really keep your churn low is absolutely number one. You got to have a great product, right? And it's got to be very, very useful. And number two is you have got to focus on what we call the customer experience management. If you don't focus on that as a small business software provider, your customers will just run away from you as fast as they possibly can.
So how do you do that at scale? I imagine most of this, maybe you start off with doing a human to figure it out, but eventually you have to code it so it becomes no touch.
Yeah. So let me give me half a second to take it back, and then I'll take you forward if that's okay. So we were this little tiny email marketing provider back in 2012, and I make this funny story that I was in a board meeting, and I went to the restroom, and I came back out, and next thing you know, they had named me as the CEO of the company because I was just a board member at the time.
How old was it at that point? When did the actual company launch?
Companies was founded in 2001, so it had been around quite a long time, and it had done like most small business, startup software companies, got to 4 million in revenue and then couldn't get past it, right? And it was just like stagnated at 4 million for like 4 years. And as a board, we said, hey, we got to do something completely different, and that's kind of when I stepped in. My background is I do a lot of acquisitions. I grow companies pretty quickly that way. So we very rapidly bought two companies. We bought the Act product and we bought Sales Logics from Sage over in the UK. When we bought the company, it was. Well,
hold on, John. Don't skip over that. How did you fund those things?
Oh boy, that one is. I'm going to write a book about that, Nathan. I mean, this was huge. So we're this little $4.5 million company, and we bought like $70 million worth of revenue.
That's why I ask.
So it was kind of crazy. So a lot of help from a couple institutionals. Oechsle KKR helped us out. Jump Capital helped us out, and Silicon Valley Bank. We went and raised the money. It was a lot of them believing in us and where we could take this thing. And they really looked at us as probably the only one that could take Act, which is a 30-year-old software company, and turn it back around.
Yep.
And so, that's how we funded it. We started out, it was a distressed asset when we picked it up. It was a closed desktop system.
When you say what are you referencing? Act,
the product, right? So Act was actually founded and launched in 1987. So it's been around a long time. It was like the father of CRM, et cetera. But it had gotten to a point where Sage owned it for a number of years, and they really hadn't kept up with the times. It was, like I said, a closed desktop system. Nobody wanted to buy desktop software. It really wasn't, focusing on customers, et cetera. Long story short, we went through this big transformation era, and at that point, I was 6'5" and had a full head of hair. And we kind of worked our way through that. We launched an open cloud-enabled platform, so a relaunch of Act in May of 2015. And then, really started focusing on conversion, what we call the conversion era, converting. We had, at that point, we had 65,000 customers around the world.
In 2012?
In 2015.
Okay.
We now have over 85,000 customers, over 300,000 users, all on our open cloud enabled platform, paying subscription, et cetera. So we've really transformed the business over the last 3 years. So how do you keep churn down? Great product, focus on that, and then really focus on getting your customers to use it. We're a CRM product. And so the biggest issue that CRM software providers have is adoption. If you don't get people to use your software and they're paying a subscription, guess what? They're not going to renew. They're just going to say, hey, I'm going to. So how do you get people up and on this thing? We launched what we call a concierge service. And the tagline is, give us 20 minutes of your time and we'll show you how to grow your business 30%. And then that way you get people
up. Is that free or paid?
That's free, actually. So it's part of the subscription. Everybody that subscribes, you get a 20-minute concierge call that basically allows us to
That's
get
a real phone call.
Real phone call, somebody on the phone talking to you.
All right, John, you're like Walt Disney here. There's magic happening here somewhere. I'm going to figure it out. What's your team size today?
We got a little over 170 people in 3 locations around the world.
What's the prime one?
So we have two big operation centers, one in Scottsdale, Arizona, and the other over in Newcastle, UK. And then our corporate headquarters is here in Denver.
Okay, so 170 team members. How many of them are dedicated to that onboarding, those calls?
Well, we probably have close to 80 some people that support the customer experience.
Okay, and what is the average customer paying per month? What's the ARPU?
ARPU right now per month per customer is about a little under $150 a month.
My gosh. So how many of these 20-minute onboarding calls are these 70 people on your team doing per day to make that actually scale at such a low price point profitably?
Yeah, so that's the challenge on this, is that not everybody takes advantage of that. So, and if you also take a look at our 80,000 customers. So here's the Walt Disney. Here's the magic. Here it comes. Ready? Of the 80,000, when you convert people over, they don't need a 20-minute concierge call. So now you're really looking at anybody that's net new coming on. So we've got about 20,000 net new customers that have come on board over the last year. So now or last few years. So now you're talking about not that many calls per month. Now, the other thing is that you got the concierge call. The other thing is when you talk about customer experience management, it's not about, hey, you subscribed, great, good luck to you. I'll talk to you when your renewal comes in. It's all about how do you stay in touch with that customer all the way through the life cycle of the year, if you would. So it's your concierge, you're up and running. Every month, what can I do for you? We have all different kinds of webinars. We have all different kinds of free content that we give subscribers. We call it being part of the ACT Insiders Club. But you're constantly in contact and understanding where the customers are. And if you start seeing people that need help, then you can do a quick outbound call to those and say, hey, guys, we see that you haven't been using the software. Is there anything I can do for you? What do you need? Et cetera. That's how you keep churn down.
I want to talk more about your Insiders Club here in a second, but in terms of general size today, 85,000 customers at $150 a month, you guys are doing almost $13 million a month in revenue, or right around there. Is that right?
Yeah, it's a little bit off, but not too far.
Okay, that's good to know. You guys are past $100 million in ARR at this point.
No, a little under. We're under that.
Will you break it this year, you think?
No, we won't.
Come on, John.
I'm trying.
More of your magic. More of your magic. All right.
Bro. Try it.
All right, I feel you. Before I talk more about your Insiders Club and specifically what activation metrics you like to focus on that drive churn down, I'm sure there's probably a few things you have to get people to do. For people listening right now that have similar experience to you, they have people that have said, we'll give you money if you find a good company to buy, and they just don't know how to structure it. Now, you do this at a huge scale because you brought in a crap ton of capital behind you. How was that actually structured? I imagine you own 10, 15, something like that percent. The investors own the rest and you're a hired gun essentially. I mean, how's it work?
Just the opposite, right? So
really?
Again, that's why we're going to write a book. So 62% of the company is owned by the common shareholders. of which I'm part of that. I'm also part of the preferred too, but our founders, et cetera. So we were able to do all those acquisitions and only give up, less than 38% of the company.
How much just for the 70? Because I mean, you essentially bought a $70 million revenue stream, correct?
Yeah, two companies.
Two companies together, 70 million. I mean, did you get them for less than 1x ARR?
Oh yeah, we got them for a steal, right? We absolutely.
Can you tell me?
No, I can't tell you.
Come on, John, you're killing me.
Sage was a publicly traded company, and I promised that I wouldn't allow that to do that. But
they didn't disclose that in the public call.
They didn't, because they bundled three acquisitions together, and they said exactly what it was.
Because you got such a steal, they couldn't tell everyone how big of a steal they gave you, huh?
They couldn't. And listen, I came from publicly traded company backgrounds too, so I knew exactly the game they were playing. But I will tell you that, I mean, we got two companies. Basically, they were distressed assets, so it was really easy to pick them up. Now, I will tell you that we divested off SalesLogix to Infor in 2014, so about a year after we acquired them, and I was able to divest Infor or SalesLogix off for 1.5 times what I paid for both the companies when I bought them together. So it was a lot of fun.
John, I want to dive more here. I mean, what you've done is you've gotten so creative with capital. This is the in essence doing something with nothing. I mean, you basically kept more than 50% of the company for common shareholders, funded $70 million in new ARR with other people's money, and then flipped around and made that money back a year and a half later by selling whatever half or a third of that ARR you acquired, a year earlier. I mean, that's basically what happened. Accurate?
That's accurate. You said it very well.
Interesting. Okay. Self-funded after kind of the M&A money, or have you raised capital since then?
Have not. Our Jump Capital has put another couple of rounds in just because they wanted to continue to help fund our growth. And a lot of what we had to do is really fund the transformation of ACT and then fund the conversion. So one of the things you need to realize, everybody does, is as you go through a license and maintenance company and you convert it over to SaaS and subscription, you need an enormous amount of cash on your balance sheet, and your revenue looks like it's going down. Why? Because you can only recognize 1/12 of the subscription if it's an annual subscription, et cetera. So all of a sudden your investors are looking at you and they're saying, John, you said this was going to create a whole lot of value. And I was like, yes, guys, it will, but we have to go through the ugliness of getting through that transformation. And when I say ugly, oh man, it gets ugly. I mean, you're talking like throw up from your baby ugly.
Describe the throw up. How bad was it?
Well, your revenue looks like it's dropping dramatically. You're investing like crazy, so your bottom line goes negative, and you're basically telling them. And I was able to actually pinpoint it and say, listen, in around the second quarter of 2016, we're going to come through the window and everything will be fine.
Did you?
And we did. Yeah, we actually did. And I was only off by maybe a month or two, so it wasn't too bad. But I'll tell you, when it got really rough, Nathan, it was like 15, the third and fourth quarter of 2015, because that was the bottom.
Why? In terms of like monthly burn cash, what do you mean bottom?
I mean, you just look at your financials, right? So, from year over year, your revenue looked like it went down 7 million. Your EBITDA was, negative with lots of zeros on the end of it. And everybody's saying, are you sure we're going to come back out? And I was like, I swear to God, we're going to come back out. Right. And so, you just have to spend. So a lot of my time at that point was making sure investors felt comfortable, the board felt comfortable. But then also we call ourselves Swifties. We're all part of Swift Page, so we got to make sure all the Swifties, can see all this too, because they're looking at this and saying, John, you said we were going to take this hill. And are we really going to take it? And they're like, we're there, guys. Just hang in there. So we came to it. But I'll tell you, 16 we came back through. 17 was a great year.
How much did you grow from 16 to 17?
16 to 17, we grew up on the top line about 23%. EBITDA off the charts because we went from negative to positive EBITDA. So hundreds of percentiles, type of thing. So
that's good. I mean, so if you're just south today of call it 90 or 80ish million in that range. I mean, you were 50, 60 million at the end of 2016 and have since scaled from there, huh?
It scales, yeah. So now it's about moving into what we call the growth era. And that's really about going out, and we're actually looking to raise some capital as well.
How much?
find well, I'm going to keep that one private for a little bit. But what we're going to try and fund is acquisitions. We have more geographic expansion and acquisitions. Those are the two things that we'd like to get some capital and go after in a big way.
Describe the perfect acquisition size for you. 5 million, 20 million, $100 million acquisitions. What's the size?
I think there's three buckets that we look at in acquisitions. I look at it as two of them are what I call adjacencies to our CRM. Then one is marketing automation and the other is sales automation.
Yep.
And then the third is a vertical expansion. We have a couple of verticals that we're pretty deep in: wealth management, real estate, and HVAC. And so, if I look at a vertical expansion, you're probably looking at anywhere from a $25 to $50 million acquisition. If you're looking at marketing automation, sales automation, it could be anywhere from like a $3 million to a $25 million.
And are you looking for distressed assets or high growth companies?
Well, there's, again, I'll go back to three buckets. We're looking for either technology acquisitions. They could have, great technology, no customers, and they're trying to figure out how to sell it. And, you can kind of pick those up relatively cheap because then they can come along for the ride. ARPU drivers, somebody that has, good technology, customers, and are looking to, another channel to sell their software. And then when you look at the verticals, that's really about, something big and transformational, if you would. Now, a vertical, that could be a distressed asset. It could be somebody that's got a really deep knowledge of the vertical, a really good following, but maybe their technology isn't really where it needs to be, et cetera. So yeah, that's the fun part now, is to try and figure out, how to make all that happen.
I'm taking notes because right now I have about 20 CEOs I'm working with that are looking to sell their companies at very rational prices. I think they potentially fit your model. I'll follow up with you obviously after this about that. But I like how you're thinking about acquisition customer growth in terms of just buying full companies. Now, when you get growth that is not from an acquisition, what are you paying to acquire customers on average fully weighted?
Our CAC, we kind of look at our CAC in two different ways. We look at it, how much does it cost us to get a net new? How much does it cost us to get a what we call a conversion, somebody that's in our install base that we're converting up there. So a net new is costing us per unit, probably in that $140 to $160 range.
And a unit is a seat or a business logo?
Seat.
Okay.
It's a seat, yeah. So, and the payback is about 5 to 6 months on a net new. Now, an install base or a conversion, we're just under $100 to from a CAC perspective. And then you can break it down even further. You can break it down direct versus channel, because we have a very large channel. We didn't chat about that. We call them ACCs, or ACT certified consultants. There's about 250 of those around the world, and they represent about 50% of our revenue right now. So it's a very, very strong channel for us.
What's the percentage payout to those guys when they bring in customers? 30%, 50%, or something else?
There's tiers, and they go from diamond all the way down to silver. And at the top, you could get as much as a 40% commission, all the way down to 10% if you're silver.
That's interesting. So that's actually a huge opportunity in terms of capital efficiency for you, because if you've got that much, that's essentially a cost of goods sold paying those guys, and it makes it 50% of your revenue. If you figure out a way where you can buy them out for the next 12 months revenue, go raise that capital, you immediately increase top line pretty significantly.
There you go.
That's interesting. Would you ever do that?
No, I think, right now our channel is a really, really, really good part of our business. And we've spent a lot of time over the last 3 or 4 years to really turn the relationship with the channel. When we acquired the ACT brand, we acquired the channel with us, and it had a very, very bad relationship with Sage. So we spent a lot of time turning that around, and they've really, really come through for us. So it's a really good part of our business.
Will you IPO in 2018 or 2019 to help fund these acquisitions if you don't go the traditional fundraising route?
I don't think so. I've taken 2 companies public, been there, done that, rang the bell on New York Stock Exchange. There's really 2 reasons why you want to go public. One is you need liquidity, and we don't need liquidity right now. And number 2 is currency, right? Do you need currency for acquisitions? I actually think that we'll go and we'll find a capital partner, and then start going down that path and really get into hyper growth mode. And then we'll make a decision, probably a little bit later on, as how do we get some liquidity after that?
Would you value yourself as you are today more or less than 700 million?
Oh, less. Yeah, no, we're less than 700 million.
And why do you say that so confidently?
I think that when people look at us from a valuation standpoint, they say, hey, you've done fantastic. You've taken this great conversion and converted a very large base over to subscription. You've shown that you can grow net new. They want to see net new grow faster, and I think that's probably holding down our value right now.
Interesting. And then last two economics here before we wrap up with the famous five. Lifetime value in terms of months. Do you calculate that just 1 divided by churn and get about 60, 70 months?
Yeah, we do, and it's right around that. It's 6.1 years, so it's where our lifetime value is.
Got it. Yeah. And then you're just multiplying that by $100 ARPU to get about $6-7 in LTV.
Yep. Exactly.
Interesting. Your payback is fairly rapid if you're paying $100, right, for a conversion, and they're paying $100 a month. Have you ever thought about getting more aggressive with CAC or no?
That is what we're looking at as we enter into growth era right now. We have this phenomenal machine, and it's just a funnel, right? So at the top of the funnel, how many leads come in? What does those leads? We call those raw leads, and then they get converted over to sales accepted leads. Got about an 82% conversion from raw leads to sales acceptance leads. We then have about a 60% conversion from sales accepted leads to opportunities, and we close in the low 50s as well. So we have a really good machine. Now you start looking at, if you take a look at our CAC and you take a look at our payback and you look at our CAC over CLV, it's about 11. And you start saying to yourself, man, maybe I should just pump more into the top of the funnel and just grow like crazy. So that's kind of one of the things that we're looking at right now.
Interesting. Last question. Do you use conference sponsorships as a means to drive growth or no?
We don't actually. We don't do that. We do hold an annual conference ourselves for all of our ACCs. And it's usually in the late October, early November timeframe down in Scottsdale. And we get probably about 50% of our ACCs will make the trek from around the world to come in. And that's think of it, they're almost like our an external sales force, or like one of our own. So that's kind of getting them together, getting them up to speed on what, how we did in the year, what's coming up in the next year, getting them all fired up, handing out awards and that kind of stuff. And it's a really good time.
All right, John, take us home here. Number one, famous five. What's your favorite business book?
Oh, Blink from Malcolm Gladwell.
Number two, is there a CEO you're following or studying right now?
There is a CEO that I follow. He is a mentor of mine. I worked for him for a number of years. His name is Jerry Stead. He was the CEO for me at IHS, where we took that company from 200 million to well over 2 billion, and then sold it for 13 billion. So yeah, he's one that I keep in touch with and follow all the time.
Number three, besides your own, what's your favorite online tool?
Oh, for me, oh my gosh, my online tool is probably one that I communicate with lots of folks. I'm a huge Twitter guy and a huge LinkedIn guy. So I try and get out there as much as I possibly can.
Number four, John, how many hours of sleep do you get every night?
Ooh, I get 6.5 hours. I'm pretty religious about that because I get up early. I'm up at 5, and I'm a huge workout guy. So I got to go to bed pretty early to make sure I get 6.
And what's your situation? Married, single, you have kiddos?
I am married to a lovely woman, Linda. And I have 4 kids and 3 grandkids.
Wow. Okay. Now, if Benioff offered you 600 million, actually, let's not do Benioff. I'm going to go with HubSpot because their ARPUs are lower than Salesforce. Maybe Brian's more a better fit. If he offered you $500 or $600 million to sell the company, and you say no, does Linda kill you over dinner tonight?
Absolutely. Absolutely. They take the money and run like a stone, brother.
All right. Last question here, John. How old are you today? And then tell us what you wish your 20-year-old self knew.
So how old am I today?
Yep.
Yeah. So I'm a speed limit right now. I'm 55.
All right.
So what I would know when 20 years ago, when I was 20, when I was I was just getting into computer. I'm an old computer guy way back. So I used to sleep on computer room floors and, program and all that kind of stuff. I would tell myself is, go raise some capital and start a business early.
There you guys have it from John. Raise some capital, start a business earlier on. I'd say he's doing it the right way. Its company SwiftPage was launched in 2001. He came in 2012. He was on the board after 4 years of stagnant growth, around $4 million in ARR, and really did something special. Raised a bunch of capital to go make acquisitions of 2 companies, which generated $70 million in ARR. He then a year later sold basically a portion of that back at the total price he paid a year earlier. So he got that capital back very efficiently. Now the company is scaling. They're growing about 20% year over year in terms of revenue growth from 2016 to 2017. Today, flirting with the 90 million-ish range, hopefully breaking 100 million here before long. He's now has an appetite for raising capital, potentially going out and acquiring additional companies in specific sectors, as well as industries like HVAC. His team of 170 people focused on onboarding and fighting for these small business owners paying $100 a month. There's 85,000 of them right now. John, thank you for taking us to the top.
Thank you so much for having me. It's been a blast.